Welcome to the Property Wealth Podcast, where we help you navigate the world of real estate investing to build long-term wealth. Today, we're diving into a topic that's super relevant right now: tariffs and supply chain issues and how they're affecting construction costs.
Yeah, it's a big deal, especially for those of us looking to invest in properties. With everything going on, it's really important to understand how these factors can impact our investments.
Exactly. We're going to break down what tariffs really mean for construction materials, and how supply chain disruptions can lead to rising costs, and what that means for you as an investor.
Plus, we'll discuss some practical strategies to navigate these challenges. Investing in real estate is always a journey, right? So, being informed is key.
Absolutely. We want to equip you with the knowledge to make sound decisions, even in a fluctuating market. So, whether you're considering a new project or managing existing properties, we've got you covered.
And we'll also touch on some real-life examples, because sometimes hearing how others have dealt with similar issues can provide valuable insights.
Yeah, and we want to keep this relatable and practical. No jargon, just real talk about real estate.
So, let's dive right in.
Sounds good, Mike. Let's start with the basics of tariffs and what they actually mean for the cost of building materials.
You know, Sarah, it's really interesting how the current economic landscape is affecting construction costs and ultimately people's ability to invest in real estate, especially for those of us over 40.
Right? I mean, many of our listeners are thinking about retirement timelines. They want to ensure they can maintain their lifestyle or even improve it as they age.
Exactly. And with inflation being a concern, many folks are looking at real estate as a solid hedge against it. I mean, property values typically increase over time, right?
Yeah, and then there's the whole supply chain issue. With tariffs and delays, the cost of materials has skyrocketed. It's like you can't even plan a renovation without factoring in those fluctuations.
That's so true. I spoke to an investor recently. Let's call him John. He had planned a significant remodel on a rental property. But when he got the quotes, he was shocked to find that, due to tariffs, the cost of lumber alone had doubled.
Wow, that's a huge hit.
Right? And John had to make a tough decision. He could either absorb the extra costs, which would eat into his cash flow, or put the project on hold until prices stabilized.
So what did he decide?
He chose to wait. But he also took that time to reassess his investments and find other properties that might not need as much immediate work. It turned out to be a blessing in disguise because he found a more profitable deal in the meantime.
That's a great example of being adaptable. It's like a reminder that, even when things look tough, there's always an opportunity if you're willing to look for it.
Absolutely. And for our listeners, especially those nearing retirement, it's crucial to stay informed about these trends. If construction costs are high, it might mean that new developments are slowing down, which could affect housing supply in the long run.
Yeah, and that's significant for anyone looking to sell or upgrade their home. If fewer homes are being built, the existing ones could appreciate faster.
Exactly. And it's not just about appreciation. There's the emotional side of financial security, too. Many people want to leave a legacy for their families, right?
Yes, that's such a big motivator. It's not just about the money, but about what that wealth can provide for the next generation.
I remember another investor. Let's call her Mary. She was in her late 50s and had a couple of rental properties. She realized that with the rising costs, she needed to start thinking about her exit strategy. How could she maximize her returns while ensuring her kids would inherit something of value?
That's a really important point. So what did she do?
Well, she decided to do some strategic renovations that would add value without breaking the bank. She focused on curb appeal and energy-efficient upgrades. Those not only increased her property's value, but also made it more appealing to potential renters.
Smart move.
Right? And that's the beauty of real estate. It's not just about the numbers. It's about creating a home that people want to live in, and that can lead to better cash flow and ultimately more wealth to pass on.
And I think it's also about understanding the market. For example, with the current economic trends, knowing when to buy or sell can make a huge difference.
Yeah. And right now, there's a lot of uncertainty in the markets. For those over 40, it's important to keep a pulse on these shifts. Tariffs might be impacting construction costs today, but that could lead to different opportunities tomorrow.
So what should our listeners be doing to stay ahead of these trends?
Well, first, I'd say stay educated. Join local real estate groups, follow market news, and connect with other investors. Knowledge is power, especially when it comes to making informed decisions.
And networking is so important. It's not just about what you know, but who you know, right?
Exactly. And consider diversifying your portfolio. If one area of your investment is hit hard by rising costs, having another investment can cushion the blow.
That's a smart strategy. And let's not forget about the emotional side of things. Knowing you have a plan can really ease those worries, especially as you think about retirement and what you want your legacy to look like.
Yes, for many people, it's about peace of mind, knowing that they're building something that will provide for them and their family for years to come.
Well said. It's definitely a journey, and it's important to approach it with a long-term perspective.
Absolutely. Now, let's dive into some core strategies that can help our listeners navigate these challenges and seize opportunities in this current landscape. So, when we talk about construction costs and their impact on real estate investing, it's really important to understand how tariffs and supply chain issues play into that. I mean, if you're looking at a property that needs renovation or new builds, those costs can swing dramatically, right?
Absolutely, Mike. I've seen some estimates that say construction costs have jumped, 20 to 30% in the last couple of years? It's wild. So how can investors like us navigate that?
Well, one of the first things to keep in mind is the asterisk 1% rule. This rule suggests that a property should generate at least 1% of its purchase price in monthly rent. So if you're buying a property for $300,000, you'd want to see about $3,000 a month in rent.
Right, that gives you a quick benchmark to see if the cash flow makes sense right off the bat. But what if the construction costs are pushing those potential rents down?
Great point. That's where you need to think about your asterisk 50% rule *2. It's a simple guideline that says about 50% of your rental income goes towards expenses. So if you're getting $3,000 a month, you'll have about $1,500 going toward costs like maintenance, property management, and, yes, construction or renovation costs.
That makes sense. So if you're not seeing those numbers line up, you might want to rethink the investment.
Exactly. And then there's understanding your asterisk cap rate, or capitalization rate, which is a bit more detailed. It's calculated by dividing the net operating income by the purchase price. So if you buy a property for $300,000 and it generates $30,000 a year in net income, your cap rate would be 10%.
Okay, so a higher cap rate usually means a better return, right? But if construction costs are escalating, that net income could drop fast.
Right, and it's crucial to factor in how those costs might affect your bottom line. If you're looking at properties that need heavy renovation, you should have a clear idea of what those costs will be, especially with materials potentially costing more due to tariffs.
So how do you evaluate those renovation costs?
One approach is to use a asterisk deal evaluation checklist. Start by estimating the costs of necessary repairs and upgrades. You can break it down into categories like structural repairs, cosmetic updates, and system upgrades like plumbing or electrical.
That sounds practical. Do you have any ballpark figures for those categories?
Sure. For structural repairs, you might be looking at $10,000 to $30,000, depending on the extent. Cosmetic updates could range from $5,000 to $15,000. And then for systems, you might be looking at $5,000 to $20,000.
Wow, those numbers can add up quickly. So it's really about doing your homework up front.
Exactly. And don't forget to factor in the time it'll take to complete those renovations. Delays can lead to lost income, as you might not be able to rent the property out immediately.
Right, and that's especially relevant right now, with supply chain issues causing delays in getting materials.
Yes, and this is where having a solid team of contractors and suppliers can make all the difference. You want to work with people who have proven track records and can give you honest timelines.
That makes sense. So let's say you find a property that seems to fit all these criteria. What's next?
Next, you'd want to consider your financing options. Traditional loans are common, but with rising rates, you might want to explore other avenues. Maybe a hard money loan if you're looking to flip quickly, or even partnerships for larger projects.
I've heard partnerships can be a game changer, especially if you're pooling resources. But what are some red flags to watch out for?
Well, you want to ensure that everyone is on the same page regarding the investment strategy and exit plan. Misalignment there can lead to issues down the road.
Definitely. And speaking of red flags, what about the type of property? Are there specific property types that are more resilient to these rising costs?
Good question. Multifamily properties often hold up better. They tend to have more consistent demand, and you can sometimes pass on costs to tenants, whereas single-family homes can be more volatile.
That's interesting. So it's about looking for properties that can sustain their value even in tougher economic times.
Exactly. And remember, it's also about location. Properties in high-demand areas might weather these cost increases better than those in less desirable markets.
Right. So it sounds like there's a lot to consider, especially with the current construction environment.
Yes, and preparation is key. You've got to be proactive in evaluating properties, understanding trends in construction costs, and knowing how to finance your investments effectively.
And, of course, avoiding common pitfalls. What are some of those to keep in mind?
Well, that's crucial. One major pitfall is underestimating renovation costs. If you think it'll take $20,000 and it ends up being $40,000, that can really eat into your profits.
Totally. And that's why having a solid budget and maybe a contingency fund is so important.
Exactly. And don't forget to research market trends. If you're not aware of the shifts in demand or pricing because of external factors, you could find yourself in a tough spot.
So staying informed is just as vital as crunching the numbers.
Absolutely. And remember, it's not just about the numbers. It's about understanding the bigger picture, like how tariffs and supply chain issues will continue to shape the real estate landscape moving forward.
This has been super insightful, Mike. I feel like I have a much clearer picture of how to approach real estate investing in today's climate.
Glad to hear that, Sarah. It's all about being prepared and making informed decisions. So, Sarah, when we're diving into the topic of tariffs and supply chain issues, one of the biggest pitfalls I see investors make is over-leveraging.
Right, that makes sense. When people get too excited about a property, they might take on more debt than they can really handle, huh?
Exactly. I had a client once. Let's call him Tom. He found this great property, thought it was a steal, and decided to max out his financing to secure it.
Oh no, what happened?
Well, the market shifted shortly after he bought it. The costs of materials skyrocketed due to tariffs, and suddenly, he was looking at a renovation budget that was double what he had anticipated. He was already stretched thin with the mortgage payments.
That's tough. So he was stuck with a property that needed more money than he had budgeted for?
Yes, and the stress of it was overwhelming for him. He ended up having to sell at a loss, which is never a good situation. It's a classic example of how important it is to have a solid financial plan and not just go all in without considering your limits.
And I guess it's also about understanding the market, right?
Absolutely. You have to be aware of the economic indicators that can impact your investment. Another mistake I see is ignoring cash flow. Investors sometimes get so caught up in the property's potential appreciation that they overlook whether it's actually generating income.
Right. Like, if the rent isn't covering the mortgage and expenses?
Exactly. I had another client, let's call her Lisa. She bought a duplex, thinking the rental income would easily cover her mortgage. But she didn't account for things like property management fees and maintenance costs.
So what happened to her?
Well, she ended up having a couple of bad tenants who didn't pay rent on time, and she found herself in a real cash flow crunch. It was a stressful situation, and she had to dip into her savings just to keep up with the payments.
That sounds like a nightmare. How can someone spot those red flags early on?
Great question. One key is to do thorough tenant screening. Check credit histories, rental histories, and references. If a potential tenant is hesitant to provide that info, that's a red flag.
Yeah, I can see how that would help. What about the timing of investments?
Timing the market is another common mistake. Many investors think they can predict market cycles, but it's really tricky. I had a friend who tried to time his purchase for the perfect moment.
Did it work out for him?
Not at all. He waited too long thinking prices would drop. When he finally decided to buy, prices had actually gone up even more.
So he missed out on potential properties?
Exactly. He ended up paying more for less property just because he was waiting for the right time. It's better to focus on finding a good deal rather than trying to outsmart the market.
That makes sense. So what about hidden costs?
Oh, hidden costs can be killer. Many new investors underestimate expenses like closing costs, insurance, and ongoing maintenance. I had a couple who purchased a property thinking they could easily renovate it, but they didn't budget for unexpected repairs.
Like plumbing issues or roof repairs, right?
Yep, they found out the hard way that the roof needed replacing right after they moved in. It was a huge financial hit they hadn't planned for.
So how can someone avoid these pitfalls?
Well, it all comes down to doing your homework. Create a detailed budget that includes all potential costs. Don't just rely on the purchase price and expected rent.
And what about a contingency fund?
Exactly. Have a contingency fund set aside for those unexpected expenses. I usually suggest having at least 10 to 20% of your renovation budget as a buffer.
That's a smart idea. It sounds like planning is key, right?
Definitely. And don't be afraid to ask for help or consult with professionals like real estate advisors or property managers. They can help you spot red flags before they become problems.
And keeping an eye on the market trends, right?
Yes, staying informed about local market conditions can help you make better decisions. If you notice a lot of new construction in an area, it might indicate an oversupply, which could affect your investment.
So it's about being proactive rather than reactive.
Exactly. And if you do find yourself in a tough spot, it's important to assess your options early. Sometimes, selling quickly might be a better choice than holding onto a losing property.
That's a tough decision, but I can see how it might be necessary.
Right. The key is to avoid emotional decisions. Stick to your investment strategy and don't let fear or excitement drive your choices.
Good advice. So as we wrap up this section, what are some next steps for our listeners who might be feeling a bit overwhelmed?
Start by educating yourself. Read up on market trends, attend workshops, or even join local real estate investment groups.
And, of course, keep your financial health in mind, right?
Absolutely. Make sure you know your numbers, set a budget, and stick to it. Remember, real estate investing is a marathon, not a sprint.
That's a fantastic way to look at it.
And patience, Sarah. That's the name of the game.
Thanks, Mike. That's really helpful. I'm excited to dive into the next part.
So now that we've covered the effects of tariffs and supply chain issues on construction costs, let's talk about some immediate steps folks can take. Practical things they can do right now to navigate these challenges.
Absolutely, Mike. It's all about actionable steps, isn't it? What do you think is the first thing someone should do?
Well, I'd recommend starting with analyzing your current investments. Just take a look at one deal per week. You can use tools like the Bigger Pockets calculator or Deal Check. Those can really help you run the numbers and see where you stand.
Yeah, and those tools are pretty user-friendly, aren't they? You don't have to be a math whiz to figure them out.
Exactly. And don't forget about local MLS access. If you can get your hands on that, it gives you real-time data on property values, which is super helpful when you're assessing potential investments.
Right. And it's also a good idea to keep an eye on local market trends. Maybe even set up alerts for new listings or changes in pricing?
Yes, definitely. And speaking of staying informed, I think it's great to follow industry news. There's some fantastic podcasts out there too, like the Bigger Pockets podcast or Real Estate Investing for Cash Flow. They cover a lot of current topics, including how to deal with these rising costs.
Those are solid recommendations. I also think reading books can be really beneficial. Have you come across any that you think are particularly useful right now?
Yeah, the book on rental property investing by Brendan Turner is a classic. It's full of insights that are still relevant, especially in this shifting market. Another one is Real Estate Investing for Dummies. It's a great resource for foundational knowledge.
Those sound great. And I think it's important to not just consume information, but also to connect with others. Maybe joining a local real estate meetup could be a game changer for someone.
Absolutely. Networking can open doors. You never know who you might meet. There could be seasoned investors willing to share their experiences or even potential partners for future deals.
And if someone feels a bit hesitant about attending meetups, they could start by engaging in online forums, right? Like the Bigger Pockets community or even Facebook groups focused on real estate.
Yes, that's a great way to ease into it. Just participating in discussions can provide a wealth of information, and you might even find a mentor that way.
Exactly. And for those who want to get really hands-on, tracking your expenses and investment performance is crucial. Using apps like Mint or YNAB can help you keep everything organized.
Good point. Understanding where your money is going will help you make better decisions. Plus, it sets a solid foundation for scaling up in the future.
Speaking of scaling, starting small can be really powerful. Maybe someone can commit to analyzing just one new property each week, or even just a couple of hours per week dedicated to research.
Absolutely. It's all about consistency. Just take small steps that fit into your schedule. You don't have to dive in head first right away. Starting where you are is key.
Love that. And for those who already have properties, looking into cost-effective renovations could really help them boost their value without breaking the bank.
Right. Simple updates like fresh paint, landscaping, or even minor kitchen upgrades can really make a difference. And those costs can vary based on your local market, so always check for the best materials and contractors.
And you can find some great resources online for DIY projects too, right? YouTube has tons of tutorials.
Exactly. Just be sure to factor in your own time and skill level when considering DIY versus hiring a pro. Sometimes it's worth spending a little extra to avoid headaches down the line.
And let's not forget the importance of having a solid team. Building relationships with reliable contractors and suppliers can really pay off, especially during times when materials are scarce.
For sure. It's all about that network. The more connections you have, the more options you'll have when challenges arise.
So in essence, it's about being proactive, staying educated, and continually engaging with the community. Those small habits can lead to significant changes over time.
Well put. And with these tools in your pocket, you're ready to move forward. There's so much potential to explore. Well, Sarah, as we wrap up, let's quickly summarize what we've covered today about tariffs and supply chains and their impact on construction costs.
Yeah, absolutely. One of the big takeaways is that tariffs can really influence the prices of materials, right? Like, when costs go up, it can affect the overall budget for a project.
Exactly, and that often leads to longer timelines, which can be frustrating for investors. Another thing we talked about was the importance of understanding the supply chain. How disruptions can ripple through the market.
Right, and that's something to keep in mind when planning your investments. It's not just about the property itself, but also about how external factors come into play.
And let's not forget about the opportunities that arise from these challenges. If you can navigate it well, you could potentially find undervalued properties or negotiate better deals.
Yeah, it's all about being proactive and adaptable. Building wealth through real estate isn't just about finding the right property. It's about understanding the market dynamics too.
And for those listening, remember, the journey may have its ups and downs, but each challenge can lead to new opportunities if you stay informed and engaged.
Absolutely. If you enjoyed today's episode or learned something new, we'd love for you to like and subscribe. And feel free to drop a comment about your biggest takeaway or any questions you might have.
Yeah, and if you know someone over 40 who wants to dive into real estate investing, share this episode with them. It could really help them on their journey.
Next time, we'll be diving into the K-shaped recovery, comparing luxury versus affordable housing plays. It's going to be an insightful discussion.
Looking forward to it, Sarah.
Me too. Thanks for joining us today, everyone.
Take care, everyone, and keep investing wisely.